Before we get started here with chapter 7, let's see if we can connect some of the dots. In the last videos, we answered a portfolio level question. How do rational investors combine risky assets to achieve the best possible trade-off between risk and return? That led us down a trail to talk about diversification, efficient frontiers, the market portfolio, and what we refer to as the capital market line. Today, we're going to come back to a security level question. Given that portfolios are diversified, what rate of return should an individual stock or asset be expected to pay? This is a really important shift, right? Chapter 6 was portfolio choice. Chapter 7, asset pricing. So in Chapter 6 told us how investors should behave. Chapter 7 tells us how markets price assets. So asset pricing models help us understand the relationships between assets and markets. They provide mechanisms to evaluate our decisions. And that the theories have evolved over time. So the connection is we have a chapter that talks about the relationships. It talks about the tools that we can use, and it also acknowledges the fact that over time theories have evolved. So let's get on and start talking about the chapter 7 here. So this chapter kind of has 3 layers to it. The capital asset pricing model is the theory, all right? It's very simple, very clean. There's empirical evidence. We'll talk about what we have been able to find in research about the capital asset pricing model. And then finally, we're going to look at alternatives. How has that model evolved through time? So the capital asset pricing model makes one of the most important claims in all of finance. Investors are not compensated for any risks that they can diversify away. This means total volatility does not determine expected return. Only systematic risk matters. This is why beta replaces standard deviation as the relevant risk measure. Again, remember in previous videos, unsystematic risk disappears in large portfolios. Since everyone is holding the market portfolio, and that is huge, capital asset pricing model simply asks, how risky is this asset relative to the market portfolio? So the CAPM equation should be read in words, not just symbols. The risk-free rate of return is the compensation for waiting. That's the time value of money concept. The market risk premium is the extra return investors demand for bearing market risk. And beta is a scaling factor that tells us how much market risk this individual asset carries. The equation does not say that high beta stocks always perform beta. You should not chase high beta. It says if you take more systematic risk, the market will demand higher expected returns over the long run. This describes the relationship between the capital market line and the security market line. So the key point is that beta is a measure of risk that describes how the market and stocks move. In fact, CAPM tells us that it's the only factor that captures the relationship between beta, between the market and stock. So let's look at some of these relationships, if you will. So here is the security market line in a graphic form. Here's our risk-free rate. At beta, the rate of return in this line is the return on the market. So we have this nice straight line. It shows that the trade-off between risk and return. Assets plotting above this line would be undervalued. They would be securities we would like to buy. And alternatively, ones below are the ones that we would not want to purchase. And if we own them, we might want to consider selling them. So why is this? Above the line, they're earning more than required for its risk. And below the line, they're earning less. This again is the foundation, if you will, of active management. However, there's no consistent. You can't to consistently exploit mispricing. You have to have superior predictive abilities, right? You have to forecast returns more accurately than anyone else. And of course, that's a pretty high standard to meet. So how can we calculate the expected return on an asset? From other videos, I'm sure you remember that if a beta if a beta is equal to 1.0, it moves 1 for 1 for the market. We say it is just as sensitive as the market. At 1.5, it's 50% more volatile than market. And 0.5, we say it is half as sensitive. So if we plug in our formulas here, for our risk-free rate is 5, and the average market return is 9. If a beta stock here as a beta of 0.7, we would expect it to earn 7.8. If the beta was 1.5 as an asset C, we would expect a higher rate, 9.6. So again, this is how we ultimately calculate, or how the theory, the security market line, tells us what the returns on assets should be. So now let's plot them. In this table, here are our expected returns from the previous slide, and here are the actual returns on the assets. So if we plot them, here's our security market line, the red line. Notice that the dots represent the assets. Some of them are below the line and some of them are above the line. Asset C, right here, is undervalued. It is above, right? So if we look at asset C, according to the capital asset pricing model, it should pay us around 9.6. However, we have estimated that this is actually going to pay us 15. So obviously, if its theory says it's only worth 9.6 and you think it's worth 15, you would want to buy that. Likewise with D, it's the opposite. That it is, for some reason, this stock should be paying us higher than it actually is. So when we compare the required rate of return to the estimated return over a specific investment horizon, this tells us, again, it gives us clues as to whether or not we should purchase or divest of particular assets. So how we calculate risk, or beta in this instance, right? If you remember, this formula, we've talked about this in previous videos, is very similar to correlation, but beta tells us how an asset moves relative to the stock market. So again, here is our formula. We have the covariance between the asset and the stock market. Divide that by the variance of the market. Once we've calculated this beta, it then plugs into our formula. Again, and here is our formula for the required return. Alpha is the intercept, beta is the slope, and the sigma out here, or excuse me, the epsilon out here, this is our diversifiable risk. If we create a big enough portfolio, this ultimately becomes a zero. So we also, again, can use the regression formulas. Here's the slope of beta. It's the slope between the stock market returns and the market returns. So how is the security market line influenced by factors, other variables? Well, time is important, right? Many different publishers use different values. Again, this is one reason why you'll find different betas to be different across the board, right? Either they are using different time intervals or they're using different markets. If we assumed everybody is using the S&P 500 as the proxy for the market, they still would have different numbers because they use different time frames. It notices here, it says Morningstar uses monthly returns over 5 years, but Thomson Reuters uses daily returns over 2 years. So obviously they're measuring the same thing, but they're doing it in different ways. So we're going to have different values. As long as you're always using the same values, you should make good decisions using the security market line. Now we also, as I mentioned, have issues with the proxy, right? What do we call the proxy? Almost genuinely, not genuinely, almost exclusively, we use something like Standard & Poor's 500 Composite. It's a large portfolio and it's value-weighted. So typically we use this, although any large index could be used. In research, the Dow Jones is rarely ever used in the sense of asset pricing. So what tests can we do of the capital asset pricing model, right? There are two most typical tests. Is it stable? Is the capital asset pricing model stable? And what is the relationship between risk and return? So we're asking two questions. Does beta remain stable over time? And do higher betas lead to higher average returns? So what are the answers to research? Beta is unstable for individual stocks, but it is much more stable for portfolios. And I think that makes sense since beta measures systematic risk, and systematic risk is the only risk we should have in diversified portfolios. Unsystematic risk is very relevant in individual assets, and beta doesn't measure it. So it does make sense that it could be unstable, or it should be unstable for individual stocks. The other thing is that the beta return relationship does exist. Might not be as steep as might be predicted in theory, but it is indeed a risk-return relationship is positive and it exists. That doesn't kill the capital asset pricing model. It just says it's an approximation, not, as it says, a law of nature. So again, what did we find out about data? What do we know about changes? So the more stable, again, beta is more stable for portfolios than for single assets. However, over time, beta tends to regress to the mean. So that if you measure this over time, A high beta portfolio over time would tend to regress towards a beta of 1, and low beta portfolios would tend to increase. Um, Again, this I believe is a function of the overall statistical characteristics of averaging, right? The more things you average together, the closer we get to the average number. The relationship, again, Sharp and Cooper here found a positive relationship, although they said it might not be completely linear. Black, Jensen, and Scholes looked at this, and they found a positive linear relationship between excess return and portfolio beta. But they, again, a positive linear relationship. So they found positive and linear, but they found that the intercept was a little bit higher than they thought. This again would imply that maybe the slope was a little less steep than what the theory shows. We also have found that there could be, since capital asset pricing model might be an approximation, what's missing? What can we add to make the capital asset pricing model more predictive? Well, we find that there are other factors. The size of companies can influence it. The PE ratio can influence. Leverage can have an influence. So again, the PE ratio appears to have some relationship to returns. That is, low PE firms tend to outperform larger PE companies. How can we explain this anomaly, since it doesn't seem to fit the capital asset pricing model? How can we explain that? There also is an impact from book to market value. So FAMA and French research has been able to capture the influence of using the book to market value. So as we move forward in this video, we're going to talk about the evolution, right? The evolution of these pricing models and where we're at currently with these models. One other thing to add, though, is that there are some influences on the research itself that really is an influence more on the returns that we look at than anything else, right? Most studies of trading rules don't include the impact of taxes and commissions. So in the research world, we refer to these as market frictions, anything that could slow down your decision. These factors, they don't really affect the security market line. They affect the research because the research is measuring excess returns. It should be excess after tax and after transaction cost returns. But that's very difficult to incorporate into simpler pricing models. Look forward to talking to you in the next video.